All right, we're going to look at the top 5 cheapest index funds out there on the market today. And this is a request from Daniel Dorado, most affordable index funds. Now, there's a few things to point out here. There are 3 good choices of websites. I'll just close everything and do it again to show you how it works. But you've got 3 good websites to look at for determining which index fund is right for you. There's Google Finance. Just type Google Finance into Google and you'll get there. There's Morningstar, morningstar.com. And then there's Seeking Alpha, which gives you the basics. Seeking Alpha is probably the fastest if you're going to buy something real quick and you don't care that much about the details. Now we're going to look at 5 index funds, but actually only 3 of them are significantly different. Because Schwab and Vanguard, so here's Schwab's Total Market Index Fund, SCHW. Schwab and Vanguard offer the lowest prices on the market, but their index funds are not mutually exclusive, they overlap. So if you look at SCHW, we're looking at the Charles Schwab Corporation. That's the holding company, sorry. What we want to look at is SCHB. That's the broad market ETF. That includes both small cap and large cap funds or stocks. So you're getting pretty much the entire market. The expense ratio is 0.03%, really cheap. And the closest Vanguard alternative is VTI. Now Vanguard and Schwab both make lots of different index funds. You can probably find one that suits your needs pretty easily. And the expense ratio is just a little bit different in terms of absolute value, but it's double in terms of percentages. So if you're really looking to squeeze every penny and get the optimal price for your index fund, you're probably going to want to go with Schwab. There's an issue though when you emphasize price over all else, and that is when a company offers an index fund at a really low expense ratio, they're probably trying to get market share from the other index funds that are a bit more expensive. They're hoping to draw out people from other index funds and add to their volume. Because as you'll see, in the Vanguard index fund, we have a volume, this is just a daily volume, but we have a volume of about 7 million, whereas in the Schwab one, we're going to see probably less than half of that volume. Take a look here. Yeah, we got less than half, only 2 million. Now, why is that an issue? It's an issue for 2 reasons. One, if there's less volume, there's less liquidity. And in a case like on Friday, when the market starts to crash and people panic sell, if you are holding an index fund with low volume and you want to sell it, it's going to be harder to sell. That's issue 1. Issue 2 is that the bid-ask spread is going to be wider. So even if you're looking to squeeze out every penny, you might be paying more because the midpoint between the bid and ask, and we could take a look real quickly, the midpoint between the bid and ask is going to be a bit higher. So let's take a look at that Schwab Broad Market Fund. And I'm not seeing here we are. Okay, so the bid and ask, as you can see, there's a spread. We have 48.43 to 48.91. There's a spread of about 50 cents there. Whereas with the Vanguard one, the spread it's actually larger. But you got to realize the price is double. Here the spread is about what, 70 cents, but the price is double. So actually the spread, you can say, if you want to standardize both of these, the spread for the Vanguard one is about 30 cents and the spread for the Schwab one is about 50 cents. So the spread's tighter on the one with higher volume, and it's really up to you. If you are worried that the market's going to crash one day and you want to be able to get out on time, then you probably want to go with the index fund that has a higher volume, even if the expense ratio is a bit higher. That's issue 1. Now, if you really care about volume and bid and ask spreads, you're probably just going to want to go ahead and go with the SPY because it has the best bid and ask spreads and the highest volume. Of course, if you're looking to save money, then SPYs, well, I mean, if you're looking to save money on expense ratio, then the SPY might not be your best choice, but still, you've got to factor in more than just the expense ratio. You can see here that the expense ratio is triple that of the Schwab. So just keep that in mind. You're going to have to do the calculations yourself based on how long you plan on holding these index funds. So overall, my meaning here is that the number one emphasis shouldn't always be the expense ratio. There's other factors to take into consideration here. Now I'm going to show you in a minute, if I have time, why I would prefer going with options on the SPY to holding any of these index funds anyway, even if you're going for a long-term investment and not a trade. And I'll show you that in a second. But let's move on to the next two index funds, which are SCHX. That's the Schwab Large Cap. By the way, I just showed you the SPY. The SPY is a large cap index fund. It doesn't cover all large and small cap stocks like the SHB and the VTI that you just looked at. So this is a better comparison. Now you can see it's the same thing, 3% expense. And for the Vanguard one, it's VOO. This is the large cap for Vanguard. So those are the two cheapest index funds for large cap. And I'm going to show you the fifth cheapest index fund in a second, but let's look into how to use Morningstar and how to use Google Finance for these index funds. So I'm going to start with Google Finance, and I'm just going to put in the funds. So let's look at the ones we just looked at, the total market, no, not the total market, the broad market. So that's the large caps. All you have to do is, when you get into Google Finance, click on Portfolios, create a new portfolio, and then add whatever you want to that portfolio. So we're going to look at the Vanguard and Schwab versions of the large cap indexes, which are SCHX and VOO. And they will appear in your portfolio. Then all you have to do is click here to select both of them, and then click on Compare. And what you'll get is a comparison of these funds, and you can choose whatever holding period you want to look at to see how it would have performed over that time. And what we're looking for is if one outperforms the other. Generally they move pretty much in tandem, but as you can see here, the Vanguard version actually outperformed. They should be tracking roughly the same thing, and that outperformance is only recently. So you should always check this before deciding, because even if you do save money on the expense ratio, you might be losing money because one is underperforming, as we see here. Morningstar here will show you the holdings of the funds. So let's take a look at SCHX, and you can look at exactly what is contained within that index fund. You're actually better off going to Schwab's website and looking up this ticker and getting a list of the holdings. You'll probably be able to download it in Excel format, but just for a general overview, Morningstar is great. You just scroll down to where it says top holdings and you click on more. But for a second, let's take a look at what's below here, the top sectors that it holds. So we've got most of, or not most of, but the plurality of the stocks in this index fund fall under the category of technology, then healthcare, then financial services. But you always want to take a look at the holdings. You might see something in there that you don't like, or you might see that it overemphasizes certain stocks and decide not to go with it. So you get a big list right here. It's really up to you whether you want all these, but you don't get that choice with the index fund. Of course, if you're asking about index funds, you've probably already made up your mind. You don't want to make up your own portfolio. You'd rather just have a straight index fund to hold on to for a long-term holding, and there's nothing wrong with that. So there you go. Now let's move on to the fifth cheapest index fund, and it's not really an index fund, it's another Schwab fund, Schwab with the Z at the end. What this gives you is exposure to pretty much every type of bond. This is the Aggregate Bond ETF, and as you can see, on Friday, the market had a 5% correction because of the Brexit issue, but the bond ETF actually outperformed the market, and you'd be doing pretty well. So you might want to go with this in addition to the index fund so that you're somewhat hedged. You have exposure to both bonds and to your stocks. So that's it. To recap, the cheapest in terms of expenses are usually going to be Schwab's funds, but again, the volume here is lower, the spreads are bigger, and then because the price is lower, the overall change in that spread that you're going to have to pay is going to be larger. And again, the expense ratio should not be the only factor in your decision here. Now here I'm going to show you a better way to play an index fund. Like I said, SPY is probably the most liquid. It is the most liquid. If you're ready to go all out and put a bunch of money into an index fund, I highly recommend that you use options instead. The reason for that is, unless you really care about those dividends that are being paid out, and if you do, then you could just safely ignore what I'm about to tell you, because what I'm about to tell you does not give you exposure to any of those dividends. So let's take a quick look at the dividends. I don't think your dividend yield is going to be more than like 2% per year here. It's not really significant, and if you're going for dividends, you probably wouldn't be going just for an index fund. But as you can see, your dividends are 2% per year. If that matters to you, yeah, go ahead, buy the index fund and hold on to that. Otherwise, try an options strategy. Here we do the SPY. Add 2 options legs. What you're going to do is you're going to buy to open calls, and you're going to sell to open puts. You could choose whatever expirations and strike prices, whatever your predicted holding period is. Let's just say we want to hold it for a month, so we'll go out to July. And then strike price, generally this strategy, because it's called a synthetic long, and if you want to mimic holding 100 shares, actually this would be 1,000 shares. If you want to mimic holding 100 shares of the SPY through options, what you do is you look at the current price and you choose that strike price. So I'm going to just show you how that would work here. So we choose 202, 202, same strike for both the put and the call. And what you get here is, it looks like a net debit. So it's going to be a net debit. You choose the midpoint between those two. In this case, it would be, well, let's say we want to round down a bit. It'll be something like 65. Okay. So you're paying $65 to mimic holding 100 shares of the SPY. Now remember, the SPY is trading at $202 per share. So in order to hold 100 shares of the SPY, if you buy the SPY outright, you're going to spend $20,000, $20,200 to be precise. You're going to be spending that much money. But if you use this option strategy, you only spend $65. And you're not leveraged or anything. It's exactly the same as if you bought 100 shares of the SPY. This is called a synthetic long. It's superior to holding the index fund precisely because you don't need that much money. And, well, the only downside here is that you don't get the dividends. By holding options, you don't get exposure to those dividends. So that's your issue. That's the only issue. And if you just want to track the market without that 2% yield, this is the right strategy. If you really care about the dividends, well, by all means, go find the index fund that's right for you. Again, the expense ratio shouldn't be your number one concern here, because once in a while you're going to be wanting to panic like the other investors, and if that's the type of trader you are, you will want to sell before the sell-off occurs and you find that there's too much slippage. So weigh those odds. What's more important to you, getting out on time and the bid-ask spread, or the expense ratio. That's really an individual decision. So right now you have pretty much all the information you need to determine whether you want to go with a Schwab fund, a Vanguard fund, which would be the happy middle ground, and the SPY or the SPY with options. Those four choices are all good choices for long-term or even short-term exposure to the general market without having to pick and choose stocks. If this video has helped you, please subscribe and like it. And if you have any questions or comments or requests for videos of this type, please leave them in the comment section below.